Most Americans believe that earning more money can push them into a higher tax bracket and result in lower take-home pay. That is not how the tax code works.
The U.S. federal income tax system is a marginal rate system. Each tax bracket applies only to the dollars within that bracket, not to all of your income. The 2024 brackets for a single filer, the first $11,600 is taxed at 10%. The next roughly $35,000, from $11,000 to $47,000, is taxed at 12%. The next $55,000 or so is taxed at 22%, and so on up through the top rate of 37%. If you earn $55,000 as a single filer, you don't pay 22% on all $55,000. You pay 10% on the first $11,000, 12% on the next $34,000, and 22% only on the portion above $47,000, which in this case is roughly $8,000. Your effective tax rate, the actual percentage of total income paid in federal taxes, is always lower than your marginal rate. A single filer earning $100,000 in 2024 has a marginal rate of 22%, but an effective federal rate of roughly 17 to 18% after the standard deduction. Earning a raise that pushes you into the next bracket means you pay the higher rate only on the additional dollars above the threshold. Every dollar below that threshold is still taxed at the same lower rate it was before. You cannot earn your way into a lower after-tax income by crossing a bracket line.
This misconception is widespread enough that some workers have declined raises, believing they'd take home less. They wouldn't. The only scenario where a raise can reduce net pay is when it phases out specific tax credits, the earned income credit, for example. But the bracket itself never causes a take-home pay decrease. Follow for more tax facts most people get wrong.